talk more about the markets. DCLA managing partner and CNBC contributor, Sarat Sethi. So, my friend, what do you do? What do you do? You got now till Christmas. Is there a Santa Claus rally in the making or not really?
I think we got most of the Santa Claus rally in November. And I think now it's time for the data to kind of reinforce or confirm, was that the right thing to do? And Andrew, I think, the jobs report's going to be really important tomorrow. I think stocks have reflected that the Fed is going to be at some point next year cutting. I don't know if that's going to happen sooner than later. I think at this point, it would probably be later. And then if they do cut, is it going to be for the right reasons? So I think you have to be very careful as to what you own in your portfolio. And I think being diversified is really important at this point. I mean, owning the Fab 7 is fine. But I think there's plenty of other opportunities. And Dom, you just mentioned something like a Campbell Soup. We don't own it. But companies that have reinforced what they're going to earn next year, that have actually some idea of where they're going to be, I think those are important companies to own. There's like a J&J or even a CVS that yesterday we owned both those that talked about it. I think you could be diversified in the food companies. They can be defensive. Budweiser.
Well, that's what I was going to ask you. Are healthcare companies in this day and age, given even what you heard from CVS yesterday, are they defensive companies?
Well, they're defensive if they've told you what they're going to earn or they're most probably going to earn. They're not defensive if they say, hey, next couple of quarters, we don't know what our earnings are going to be. But if they have a much better window, I think you are going to be much more defensive. Like take a CVS, you've got a dividend north of 3%, trading at a single-digit multiple. J&J trading at 15 times with almost a 3% multiple. Not only are they defensive, they can also have upside earnings growth if things go better, because we always know companies kind of underpromise and try to overdeliver. So you can find other opportunities. And when you look at the market overall, you have almost 490 companies that have done nothing all year.
Okay, but it sounds like you're moving into defense rather than offense after this sort of, we'll call it the Thanksgiving rally, I guess, for now. At what point in 2024? I would say
I am taking profits from my companies that have done very well. I'm not getting rid of. I still own Meta, but I will trim it back. Same thing with Google, and I will deploy it into other areas of the market that I think have better or equal opportunity.
Okay, but play out 24 for a second, because we're all walking into a presidential election year. That's typically, given the circumstance, I think you could argue historically would be a flat kind of situation, not necessarily some kind of there's going to be a lot of uncertainty. I imagine, maybe not. I don't know. And then you're going to layer on the Fed on top of this about whether they can quote stick the landing or not. And you got Jamie Dimon on one end, and you have the market right now on the other in terms of what he's going to do.
So that's why I've been saying get into some of the other stocks that can do well, even if the overall market doesn't do well, because they have secular tailwinds behind them. That's going to be the idea. You might not get that multiple expansion we got this year. And even if you get earnings growth, it might just be to catch up to the multiple. So be diversified. You can own the Mag 7, but make sure you own other things in your portfolio as well.